This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
At the end of chapter 13, I introduced you to what we'd see now within chapter 14 and the different reliefs and types of relief that we'd have to contend with. The first of these reliefs is entrepreneurs' relief. The type of relief that it is a lower tax rate. That we are able to benefit from a 10% tax rate, which, as we'll see in these notes in a moment, will extend up to a maximum £10 million worth of gains in any taxpayer's, any individual entrepreneur's lifetime. A lifetime limit of 10 million. That should be more than enough to keep most of us going, I would think, there. So it's the relief, a lower tax rate. We pay tax at 10% instead of on these numbers what would ordinarily and otherwise be 20%. So what we have is a reward given through the taxation system to those people who've taken the risk of setting up their own businesses and eventually have been rewarded for that in terms of being able to dispose of their business at some higher value than the total amount of costs they incurred in terms of the capital costs of that business. More of that in a moment's time. And what we're able to do, therefore, is to reward these taxpayers by, as we've said, as they're all going to be higher rate taxpayers, halving their tax rate. You can look forward to, if you set a business up, you run it successfully, you're then able to sell at a higher value, then any gain you make on that disposal, up to a maximum 10 million anyway, will only be taxed at 10%. Okay, we've got to learn the details of this. Now, we've been talking here about the disposal of a business. Now, there are two types of business entity that we should be aware of already, something that you came across indeed in your accounting studies. You could be an unincorporated trader. Unincorporated, not a company. The unincorporated trader, a sole trader, an individual working for him or herself, or of course a collection of such individuals, a partnership. In which case, when you have a disposal, the disposal is of the assets and the trade of that business. You could instead have run your business through a company, in which case, when you dispose of your business, you are not disposing of the assets and trade. The assets and trade of the business are owned by the company. What do you own in the company? And what do you own? You own shares in that company. And those shares, depending on the level of shareholding and depending on some other compliant conditions being satisfied, they too may rank for entrepreneurs' relief. So we've got a disposal here of a business, or indeed part of a business. The relief is available for individuals disposing of a business or part of a business. As we know, it covers the first £10 million worth of qualifying gains. Once you've used that up, you'll be dealing with a higher rate taxpayer, and therefore you'll revert to a 20% tax rate. And that is a lifetime limit of 10 million. Not each individual gain, it's a lifetime limit. So if you were told at a question that the taxpayer had already had gains of £8 million in previous years that are qualified for entrepreneurs' relief, only £2 million worth of that 10 million lifetime limit would still be available to you. This gain qualifying is taxed at a CGT rate of 10%, regardless of a person's taxable income. Doesn't matter whether you're basic rate taxpayer or higher rate taxpayer, you're going to be taxed at 10% up to that 10 million limit. Now, again, wherever there are reliefs, there are conditions that need to be complied with. If HMRC is going to be generous, there are limits to their generosity, and you must play the game that they create the rules for. These are the rules that need to be satisfied for this relief to apply. So what have we got? Firstly, we've got to have a 2-year period of ownership. The assets must have been owned for 2 years prior to the date of disposal. Now, if you had studied for this exam for exams prior to June 2020 anyway, you would have seen that then the qualifying period was just 12 months, 1 year. Note now, from June 2020 onwards, until such time as they change their minds again at HMRC, it is a 2-year qualifying period. The relief is available on a disposal of the whole or part of a business run as an unincorporated business, i.e., as we said, you the individual sole trader, or you are a partner in a partnership. The relief is not, therefore, available if a trader simply disposes of an asset that is used within the trade. But see next point on the sale of assets post-cessation of trading. The assets in question must be used for the purpose of the business, so the relief is not available on investments. So here it says relief is firstly not available if a trader simply disposes of an asset that is used in the trade. So if you're an unincorporated trader or you're a partner in a partnership and the business disposes of a business property, you're expanding your business, you dispose of that business property and you replace it with another business property. The gain made on the sale of that first business property does not benefit from entrepreneur's relief. All you are doing is selling an asset that you used within the trade. You are not disposing of the trade itself. Sometimes with such businesses, there may be more than one type of trade operated by that business. So what you might be able to do is to sell off one of those trades, an identifiable part of the business, while still continuing that business and trading in that business in the other trade. So there must be a trade, there must be an identifiable part of the business that is disposed of. Merely selling an asset used within the trade does not rank for entrepreneur's relief. But what we'll discover later in this chapter, if the most likely circumstance I gave you, the business disposes of a business property and were to then go out and reinvest the sales proceeds of that business property in another, a replacement business property there, then in those circumstances, the gain arising on the sale may in fact be deferred through a relief we made mention of at the end of chapter 13, a relief called Rollover Relief, which we'll be doing just a little bit later in this chapter. So where that individual property is disposed of and replaced by another business property, then we'll discover that rollover relief, if its conditions have been satisfied, may then be claimed, and in those circumstances either all, or at least hopefully some part of that gain, may then be deferred. And that's called rollover relief. But for entrepreneur's relief, it must be the entire business, or at least an identifiable part of the business, not simply an asset used within that business. Individual business assets of the individuals or partnerships trading business that has now ceased. What may happen is that the business may have got into difficulties, and maybe this trade, this sole trader business or partnership, although having still assets of significant value, may not be able to sell the business off as a going concern at one point in time. Their trade ceases because they sell it to a third party. There may not be a single third party that wants to acquire that business. But my business, though it's no longer a going concern, still has valuable assets like a business property. Well, what this is telling you is if then within that period of, here's the note here, the disposal of the assets must take place within 3 years of the cessation of trade. So you've got into trading difficulties, you no longer a going concern, you stop trading. But it takes you a month, 6 months, 12 months, up to a maximum of 3 years post cessation of trading to sell off one or other of the assets. The most likely one giving rise to a capital gain, a chargeable gain, would be your business property. There, although it's just a business property being sold, in those circumstances, yes, that gain then would be eligible for entrepreneurs' relief. We do not punish the taxpayer any further in a situation where their business has ceased to trade, but when unable to make a sale of a qualifying business asset at that point of cessation of trading. We have to wait and later on, but within a 3-year period there, then dispose of the qualifying business asset. That's usually a property. Not all businesses are unincorporated, and quite frequently in exam questions, it's shares in a trading company that are being disposed of that may then also rank for entrepreneurs' relief. What are the conditions here? The disposal of shares in a trading company has to be a trading company. And there's a minimum shareholding where the individual has at least a 5% shareholding in the company and is also an employee. Now, that may either be part-time or full-time of the company. So you've got to have owned at least 5% of the shares and been an employee of the company, part-time or full-time, for, now again, it's a 2-year, a 24-month period prior to disposal. So whether you're disposing of the unincorporated trade or now shares in a trading company, the minimum period of ownership you have to have, plus in this case in terms of shares, you must also have been an employee. That minimum period is 24 months, 2 years up to the date of disposal. There is no restriction of the relief if the company owns investments. Now, I say there's no restriction, so we don't try to proportion out an amount of gain that qualifies for ER and an amount of gain that doesn't. What you have here is an all or nothing situation. And what they'll do is to tell you in the question that the company is either a trading company and therefore will benefit from entrepreneurs' relief, so long as these other conditions have indeed been satisfied, or it is an investment company, in which case, no, you do not have any entrepreneurs' relief there. So, if you've got a small proportion of what is a trading company's assets in the form of investments, then if it is still classed as a trading company, you will get entrepreneurs' relief in full. There will not be an apportionment of the gain that is eligible for relief. It's all or nothing. If it is still a trading company, you get ER. If it isn't, you get no ER on any of those gains. This is a relief that has to be claimed, as most are, unlike the one dealt with it back in Chapter 13, the share for share relief, where if you complied with its conditions, it automatically applied. But there was also an election. There you elected to disapply, to say, no, I don't want to have that relief. Most reliefs are, pretty obviously, if you want them and you're entitled to them, i.e. you've satisfied the conditions, then you claim them. And there's always here some time limit. So the time limit for the claim must be claimed within 12 months of the 31st of January following the end of the tax year in which the disposal is made. Thus, if you made a disposal in 1920, then the next 31st of January would be the 31st of January 21. This must be claimed within 12 months of that 31st of January that followed the end of the tax year. So that takes us from 31st of January 21 to 31st of January 22. So you've got ample time here to think about this. Now, again, it's a no-brainer. if you qualify for ER, and if the gain would otherwise have been taxed at 20%, what are you going to do? Of course, you're going to elect to be taxed at 10% instead of 20%. The only issue here is, have you qualified? Are all of the conditions that need to be satisfied actually satisfied? Then, of course, you'll make the claim. But there's the time limit. Maybe that the taxpayer hasn't taken advice, but then comes to you at a later point in time to seek that advice. And then, as long as you're within that time limit, the claim can still be made. If, of course, we're talking about disposals made in the 2021 tax year, the 31st of January following the 2021 tax year would be the 31st of January 22, and 12 months on from that is, of course, the 31st of January 23. Okay, now we have an example. Here in this first example, we're dealing with an unincorporated trade, and we're told that on the 30th of September 19, Daisy sold a business that she'd run as an unincorporated trade. And she'd run that trade since February 2012. The sale resulted in the following: capital gains and indeed capital losses on the disposal of the business assets. If you are disposing of an unincorporated trade, you must ensure that you pick out from the balance sheet, the statement of financial position of the business there, you pick out what are chargeable assets. Not all of the net asset value within the company, within the trade here. This is an unincorporated trade, pardon me. Not all of those assets held within the business are going to be chargeable assets. Think all of your current assets, your inventory or stock, as I would call it there, your debtors or receivables, your cash. None of those are chargeable assets. They're trading assets there. There are no capital gains to be made in those circumstances. So we're only going to pick out the chargeable assets. Again, go back to the beginning of Chapter 12 in relation to our introduction to CGT to understand that all assets are chargeable unless they're specifically exempted there. And again, we will be looking at probably these main assets for an individual for an unincorporated trade as being chargeable. Obvious ones: properties used within the trade. Factory, warehouse, could be office premises there used within the trade. So any such business premises are clearly chargeable assets, and any gains or indeed losses, as we'll see here, are brought together to establish an overall net gain on the disposal of the business. And it's that overall net gain on the disposal of the business that then, as long as we've satisfied the conditions, will qualify for ER. There is a classic and dreadful student error that is made all the time by students who have not properly understood this point. And what it is the question tells you that the individual sold his or her business for £1 million. They then give you the balance sheet of the business expressed at market value, as well as giving you cost figures for various assets contained within that balance sheet, that statement of financial position. And the unwary student, they say, okay, sold the business for £1 million. Capital gains calculation, sale proceeds 1 million. What cost do I have of all of those assets? That's the cost. No. Horrible, horrible, horrible. There is no chargeable asset called the business. Instead, the unincorporated business is made up of lots of different assets, some of which will be chargeable, some of which will not be chargeable. So when you look at the balance sheet of the unincorporated trade, you have to pick out which of those assets are chargeable and which are not. And for each of the individual chargeable assets, here we've said so far about properties used within the trade, a factory, a warehouse, office premises. An individual gain is computed. What is its value? What, if any, was its cost? Now I say what, if any, clearly properties will have a cost. But as well as tangible assets here upon which gains arise, there's also one main intangible, goodwill. And if you started your trade from nothing, you didn't buy an existing trade, then goodwill has no cost. You've created all of the value of that gain. It makes it a very easy gain to compute, of course. Here, the goodwill, here given at $250,000. So whereas with a factory or warehouse, you would have a market value for each of those assets and an original allowable cost for each of those assets, allowing these gains or these losses here to be computed. I've given you the numbers there. In an exam question, you may have to calculate those numbers for yourself. But those are basic individual gains. For the goodwill, you'd be told market value $250,000. There is no cost, and therefore the gain is £250,000. Right. So from the balance sheet of the business, we pick out which of the chargeable assets and individual chargeable asset by individual chargeable asset, we compute the gains and, if applicable, losses. We then establish the overall net gains. So you would therefore get, to go into your answer, what would be the net gains arising there. Now then, the question is, on those gains, the net gain arising, will Entrepreneurs Relief be available? Well, we're told that the disposal sold on 30th September 19. It's an unincorporated trade run since February 2012. What's the relevance of that date? The relevance, of course, is that it's now more than 2 years since that date. We've run the business for the qualifying period of 2 years, and therefore, using that criteria, Entrepreneurs Relief will indeed be available. So, the net gains arising, I'll leave you, of course, to compute what those net gains will be. Those net gains will be eligible for Entrepreneurs Relief. We've satisfied the conditions. If again you're doing an objective testing question, all you're interested in is an answer to the question set. Here, calculate Daisy's capital gains tax in 1920. If you're doing a Section C written question that were to involve anything of this nature, then of course you would also be stating all of these compliant conditions and identifying that they have been satisfied. The business has been run for at least 24 months, at least a 2-year period, therefore qualifies for Entrepreneurs Relief. So those net gains will qualify. But it doesn't stop there. In December 2019, Daisy also sold a 20% shareholding in Bed Limited, an unquoted company. Daisy has been an employee of Bed Limited from the date she acquired the shares in July 14. The gain arising was £370,000. Now, what that question also should have said here is that it's an unquoted trading company. And so long as it's a trading company, if it just said unquoted company, then I'd still assume, if the other conditions have been satisfied, that it is a trading company and therefore that Entrepreneurs Relief would be available. It is not, of course, going to be available, and I'd have to tell you this, if it's an investment company. Investment company, no, you do not get Entrepreneurs Relief. So we've got a gain arising here of £370,000. Now then, does that gain on these shares qualify for ER? Now, there's two main conditions that we're aware of that need to be satisfied over the last 2 years. One, we need to have owned the shares for a minimum 2-year period. Well, the disposal, December 19, and we had acquired the shares in July 14. yes, we've got the 2-year period. But also, of course, Daisy needs to have been an employee, whether that's full or part-time, doesn't matter, but needs to be an employee. Daisy has been an employee of Bed Limited from the date she acquired the shares. So again, for the last 2 years, yes, she's been an employee. So what we've got here is 2 types of gain: net gains on the disposal of the unincorporated business, disposal of shares in what must be an unquoted trading company, both of which therefore have satisfied its relevant entrepreneurs relief conditions, and therefore entrepreneurs relief will be available. So both of those gains will qualify for the 10% rate. Now, again, just by looking at the numbers there, you can see that we're getting nowhere near the £10 million lifetime limit. There's no statement as to any earlier gains that would have used up any part of the 10 million lifetime limit. So we are comfortably within the £10 million limit. So yes, all of those gains will qualify. But we've got to calculate the capital gains tax. Now remember, what we are able to do here from the numbers provided to us is to put together a total figure of gains qualifying for entrepreneurs relief. Remember, the relief is a tax rate. We only apply the tax rate once we've computed taxable gains. So let's see how much from our studies of chapter 12 you have remembered here. You now need to compute what those taxable gains are and apply the relevant CGT rate. So you finish this exercise off and then come back and join me, and we'll just review through that answer and pull out the important points, hopefully confirming, of course, what you yourself have already determined in your own answer. So finish that exercise for me and then come back and join me. Okay, let's confirm therefore our answer to example 1 here in chapter 14. Again, there were 2 disposals that occurred. There was the sale of the business, but remember there's no individual asset known as the business. Instead, it was made up of a number of different chargeable assets held within that unincorporated trade. Those were all given to us, and we established therefore net gains of $480,000 on the disposal of the unincorporated trade. The sale of the shares, we had also determined the reasons down here as to how it is and why it is that each of these gains does indeed qualify for ER, that is provided to you. Obviously not necessary on an objective testing question. They just want to see, can you get the answer right? But that's the reason why. The sale of the shares, the gain there, $370, and again for the reasons prescribed down here, we qualify for entrepreneurs relief. So the total net gains equal to $850,000 all qualify for entrepreneurs relief. So when we deduct, as we always do, our AEA, then we are deducting from, yes, 2 gains, the sale of the business assets and the sale of the shares, but both gains will qualify for entrepreneurs relief. So they're the same tax rate. So in which case here, it doesn't matter which of these 2 gains, the 370 or the 480, that we are offsetting that AEA against, because both of them have exactly the same tax rate. Now, if you recall, as I hope you do, early on in our studies at the beginning of chapter 12 on CGT, we saw that you are able to deduct not just an AEA, but any losses brought forward from previous years. You could deduct those deductions, AEA and losses brought forward, from those gains that would be taxed at the highest tax rate. So if you had gains qualifying for ER and other gains that did not qualify for ER, and you were a higher rate taxpayer, then those other gains would be taxed at 20%. So clearly, where do you want to make your deductions of what here would be, we only got an AEA, but in other circumstances could be both an AEA and capital losses brought forward. Where would you want to make that deduction? You would want to make that deduction against those gains that would be taxable at the higher rate. So the deductions would go against the non-entrepreneurs relief qualifying gains, and that would leave all the other gains on the ER assets still taxable. But those would be taxed at 10%. Take the deductions from those asset gains that would be taxed at above the ER rate of 10%. And we're allowed to do that. So you'll see that happening again. Well, not in this example, but indeed in the next example, with a few other issues also involved. So here it didn't matter whether or not we were in fact applying AEA of the existing capital losses against the gains on the sale of the business or the gains on the sale of the shares. All of those qualified for ER. If, for example, the sale of the shares was non-qualifying, they weren't qualifying shares, it was an investment company, or the individual, though owning shares in a trading company, was not an employee of the company, so it didn't qualify. Then we'd have non-ER assets. And what would happen, of course, is that those gains on the shares of 370 would be put into a separate column here. And what would we then do? The AEA of 12,000 would be deducted directly from those gains, reducing those gains that will be taxable at the higher rate, leaving the 480 to be taxed at the 10% entrepreneurs relief rate. Now, that point and one or two other issues here about the calculation of our CGT, where we have a mix of gains that qualify for ER and gains that do not, are picked up again back in your note here on this section 1.4 further points. We've already said here in this second of these points, the AEA and any capital losses should, however, be deducted firstly from gains that do not qualify for entrepreneurs relief, as they are taxed at a higher CGT rate of 20%. Now, again, I'm assuming 20%. We're a higher rate taxpayer, and therefore all other assets are going to be taxed at 20%. Clearly, of course, what we might have is residential property, where even if you were a basic rate taxpayer, you'd still be paying tax at 18%, and more likely a higher rate taxpayer would be the case, and therefore would be 28%. You're always going to use the deductions against those gains that would be taxed at the highest rate. 28% compared to 20%, compared to 18%, compared to 10%. The easiest approach, as we've just seen in dealing with the questions that include gains qualifying for ER and gains that do not qualify, is to keep the gains separate. So we'll separate out, therefore, into two columns, gains qualifying for ER and gains that do not qualify for ER. And we will deduct then those deductions, principally the AEA and the capital losses brought forward. We'll make those deductions from those gains, whichever they are, that are being taxed at the higher rates. So that is the non-entrepreneur relief gains. Entrepreneur relief gains, as we know, are going to be taxed at 10%. But then there's another issue. I've just said we're assuming that our taxpayer is a higher rate taxpayer. Well, of course, what they may do is to give you the taxable income. And the individual at the moment, prior to dealing with their taxable gains, may be still just a basic rate taxpayer. That's where this critically important point comes in. The gains qualifying for entrepreneurs relief must be taken into account when establishing which tax rate applies to other taxable gains in the tax year, in that they are deemed to firstly use any amount of unused basic rate band. So the gains qualifying for entrepreneurs relief must be taken account when establishing which tax rate applies to the other taxable gains in the tax year, in that they are deemed to firstly use, this is the gains that qualify for ER. So although whether you're basic, whether you're a higher rate taxpayer, doesn't matter, because the ER rate is that set 10%, assuming we're not going above the 10 million lifetime limit, of course. But what happens here is that those gains qualifying for ER are deemed to firstly use any amount of unused basic rate band. So here's just a few basic numbers that I've set up for you. Off the taxpayer's income tax computation, we have note taxable income of £20,000. Now I could have said net income. If I'd given you net income, you'd need to compute taxable income, as we saw early on in Chapter 12, and therefore you'd need to deduct the personal allowance. Read the information carefully. So I've given you the taxable income. So the taxable income is 20,000. That means that with a normal basic rate band for taxable income of 37,500, that we'd still have some, indeed £17,500 worth of basic rate band available in terms of taxing your taxable gains. And we then see that our gains, we've already done the split. We've got £100,000 of gains that qualify for ER and £20,000 of gains that don't qualify for ER. So the issue. First of all, of course, we must establish the level of taxable gains. So we're going to have those gains that qualify for ER and those gains that do not qualify, non-ER. Now we know what those gains are. The gains qualifying for entrepreneurs relief. Now, of course, you'd have to establish for yourself, no doubt, in a question, that the £100,000 gain was on qualifying business assets on a disposal of a business and therefore qualified. Those gains were £100,000. The non-ER, £20,000. But of course, no information here about capital losses brought forward, but every tax year we have available an AEA. And for us, for 1920, we got a £12,000 AEA, as we saw in that example 1 there a moment ago. Now then, where are we going to deduct here these gains? This AEA. We're going to deduct from those gains that would otherwise be taxable at a higher rate. Those are the non-ER gains. So our AEA will go there now. As that figure, 20,000, is more than 12,000, it uses up all of the AEA. And that brings us down to now, of course, again, hopefully remembering from Chapter 12, the other thing that you needed to compute, taxable gains. So our taxable gains qualifying for ER here, 100,000. The non-ER qualifying gains have been reduced to £8,000. It's at this point, having got taxable gains, that we consult, of course, the income tax computation, where we discover that we have taxable income of £20,000. Now that, as we said, would leave basic rate band available of 17,500. And without the note that we have read, you might think that, non-ER gains are only 8,000. So those 8,000 would enjoy the remaining basic rate band. Answer to that is no. Look back at the note. The gains qualifying for entrepreneurs relief, in this question, £100,000 gains qualifying for ER. The gains qualifying for ER must be taken into account when establishing which tax rate applies to other taxable gains in the tax year. In that, here the gains qualifying for ER are deemed to firstly use any amount of the unused basic rate band. So looking at the information in our question, we have got taxable income of 20,000, an unused basic rate band of 17,500 to take us up to our normal limit of 37.5. Remember again, that basic rate band, as in income tax, can be extended in CGT also for the gross amount of any gift aid payments or personal pension contributions paid. But otherwise, no information about that. We've got 17,500 left. And what we've now got to understand is that in determining the... Why those figures go funny there? In determining the tax rates applicable to the non-ER gains, unfortunately now a rule that does not work in our favour, those gains that qualify for ER would be deemed to firstly use up any remaining available basic rate band, i.e. the 17,500. Irrespective of the fact that those ER gains are never going to be taxed here at 20%, they're only going to be taxed at 10%. Those gains are deemed to firstly use any amount of the remaining basic rate band. So although we have an available basic rate band, still available to us for gains of 17,500, taxable income off the income tax comp 20,000, that's used 20 of 37,500 basic rate band, 17,500 is available. None of that 8,000 will enjoy any unused basic rate band, because this £100,000 of gains qualifying for ER are firstly deemed to have used up that remaining basic rate band. 100 is obviously very much bigger than the 17,500, 100,000 much bigger than that. So there's no basic rate band available. So it means that in terms of these gains, taxed at, the entrepreneur relief gains will be taxed at 10%, but these non-ER gains will all be taxed at 20%. There'll be no 10% band available to tax those non-ER gains at. So these points here, therefore, are critically important in understanding, having got the gains that qualify for ER, having got the other gains that do not qualify for ER, if they ask you to compute the CGT liability, there's two main hurdles to overcome. You must firstly understand that in getting the taxable gains, this is a good point, that any deductions in the form of AEA capital losses brought forward will reduce the non-ER gains, i.e. those gains taxable at the higher CGT rates. So you get your taxable gains. But then, if on your income tax computation you were still a basic rate taxpayer, so there is some unused, some available basic rate band, that unused available basic rate band is firstly deemed to have been used up by those gains that qualify for ER. And if that means that those gains are bigger than the remaining unused available basic rate band, that goes. So your non-ER gains will, as in the example I've just shown you, all then be taxed at 20%. Okay, you've got an example here, therefore, example 2, for you to have a go at, where again, you've got to calculate Anne's CGT for 1920, and indeed state the due date for payment. So you have a go at that now, using the structure that we've identified, ER qualifying, non-ER qualifying. Where do you make your deductions to give you taxable gains? How do you then determine what, if any, basic rate band is still available for the non-ER gains to enjoy, and then proceed to tax those taxable gains? Have a go at that, and then we'll finish off this particular lecture by having a quick review through to make sure you didn't have any problems with it. Okay, let's see how we fared, therefore, with example 2. Again, although not labelled, what we have here is a column to deal with those gains that qualify for ER and those that do not qualify for ER. The gains qualifying for ER, that was the sale of the shares, and we've got ourselves a capital, if not taxable gain, of 4.5 million. The gain on the sale of the painting, clearly not an ER qualifying asset, £100,000. We have available two deductions here, the AEA and also the capital losses brought forward. And as you'll have read in note 1, as we did with our example, any deductions in the form of AEA and indeed capital losses brought forward, they would go against those gains that are non-ER, i.e. those that would be taxable at the higher tax rate. So that brings us down to a taxable gain of 63, and that's how we know that the capital gain in relation to the sale of shares, that is also the taxable gain at 4.5 million. So the 4.5 million, being less than 10 million, will be taxed at 10%. So irrespective of whatever your taxable income off your income tax computation might be, those gains less than 10 million haven't used before any of your lifetime allowance, and therefore you're going to have 10% tax charge. The question, of course, is what tax rate is going to apply to that 63. Now again, we had to establish what basic rate band was still available. Although £19,500 worth of Anne's basic rate band is unused, the basic rate band limit, 37.5, minus the taxable income of 18,000 there, this is deemed, so this remaining 19,500 of Anne's basic rate band is deemed to be utilised by the gains qualifying for ER, even though we know that that 10% ER rate will always be applicable to those gains. What does it do? It pushes all of the taxable gain on the painting into the 20% band, which explains why it is 20% on that painting gain. It at least got to enjoy the use of deductions, AEA losses brought forward, but because the ER gains are bigger than the remaining available basic rate band from your income tax computation, it pushes all the other non-ER taxable gains out of the basic rate and up into a 20% rate. In terms of when we pay the tax, of course, the 31st of January following the end of the tax year. Okay, that sorts out for us, therefore, our study of Entrepreneurs Relief. That's enough for this particular session. What we'll see at the beginning of next session, something that's only become examinable from a computational point of view from the 1920 tax year, something called Investors Relief. But as you can see from the length of that note, it's not a huge one, therefore, and we'll deal with it. Not one of the main ones, hasn't previously been something that could be examined, so probably, as it's a new toy for the examiner to play with, it may very well get a testing in our first round of exams in the 1920 tax year at some point in those exams. That we will hopefully be able to relatively quickly deal with, because it's, again, not so much a doing exercise, but a learning exercise, and that's down here. I'll show you what to do, but you then have to learn the procedures. Rather more a doing as well as a little bit of learning is the next major relief, rollover relief, which we'll also get on to and deal with in our next session together.